Well, good evening, everyone. Welcome to another On the Move webinar. I am one of the co-hosts, Adrian Day, and I would like to introduce my fellow co-host and actually the head honcho who started this series, Rich Checkan. Rich is the CEO, President, COO of Asset Strategies International, which, as you can probably figure out from the from the pictures behind him, is a coin dealer. They sell coins, bars, anything gold and silver, platinum and palladium as well. They're also involved, one of the distributors of the Perth Mint certificate. So lots of ways in which you're going to get exposure to gold and silver through Rich's firm. And we'll get more into that later if we may, but why don't I turn it over to my co-host,
Uh,
Rich?
thank, thank you, Adrian. And welcome, everybody. I'm Rich Checkan. I'm my co-host, Adrian Day. For those of you who don't know Adrian, which I'm surprised if you don't, but he's an amazing asset manager dealing with international and resource stocks. We've known Adrian for, here we go again, Adrian, was it 25 or 40 years or what have you? But all wonderful years and a great relationship we have with him. He's a trained economist. He's written books on asset management and investing in resources and so forth. If you haven't read them, you should. They're amazing on the topic. He's sought after for speaking at conferences and on TV and radio, and he knows his stuff pretty darn well. I can tell you, he does a great job for us on the asset management side as well. If anybody in the audience uses his services, I think you can attest to that as well. And Adrian, I'm excited. Tonight we have an incredible guest. Um, I don't know that a lot of our people know you, Avi, but they're about to. So we've got Avi Gilburt. He's the founder and he's an analyst with Elliott Wave Trader. And he's got an interesting background. He started up as a New York native, went to Queens College, got his BA in economics and accounting, St. John's for his law degree, he went to NYU for his master's in law and taxation. And then he started up with a firm where he became the national director and partner, where he basically ran the state and local tax department. And he co-chaired their healthcare department. He headed up some of the largest national healthcare deals during this tenure at the firm. And then at the age of 33, he stepped away. Right? He had some issues with his wife. And stepped away to raise his family. Very, very honorable what he did. And as his kids got older and things got settled, he was able to step back in and pursue his passion. I think he got introduced to Elliott Wave. Technology or technicians, and kind of found his way. And then he started Elliott Wave Trader. He's got 8,000 clients, and about 1,000 of them are money managers worldwide. He's now local here to us in the DC area. He's a highly sought after speaker. I was introduced to Avi because we had a friend for 40 years who had been following Avi, and he said, "You need to listen to this guy." And I reached out to Avi and I said, "Hey, can we get together? We're both going to be in New Orleans. Let's kind of figure it out." And Avi is a gracious, wonderful man. He said, "Yes, let's get together immediately." We followed up with dinner back here, and I'm glad to know you, Avi, and I'm so glad that you're joining us here tonight.
Thank you so much for having me, but I don't know if I'm going to be able to get my swelled head through this webinar now.
That's okay. That's okay. We'll help you fit
Oh
through
my
it.
God.
The,
Well,
the
the only
bottom line,
the
bottom
only
line is Avi is an amazing uh, gosh, thinker. And he's going to come at you on some of the issues we're going to talk about tonight from directions you probably didn't see coming. And I just encourage you to have an open mind and listen because his track record speaks for itself. So, Avi, again, welcome.
Thank you.
So, I kind of want to jump right into it, if that's okay. And first question I've got for you is you've made it very clear in our previous conversations that you are, I think I said scared to death this morning on the video, but actually you said banking sector is scared the crap out of you, I think is actually the quote you said when we last spoke. So basically, we want to discuss your take on the markets and everything this evening, but I want to start with the banking sector because this is so important to you. And you've done a lot of research in this area, and there's a reason that banking has scared the crap out of you. And I kind of want to know what that is. And I think our listeners do too.
Well, yeah, that was the phrase I used. It does scare the crap out of me. It all started. It was about a decade ago, oddly enough. I wrote a public article. I wrote an article for our clients, and then I put it out publicly. I think it was on Market Watch at the time. It was a highly read article. And in that article, I said that, I feel like the biblical Joseph because, I said, from looking at my charts, I think, maybe we have another good decade or so. But after that, I'm seeing a decade or longer of really bad. So, my clients would ask me, well, then how do we prepare? So I told them a number of things, make sure you don't have any debt, make sure you have a good source of reliable income that can take you through an economic turndown, which could be a prolonged economic turndown, and also make sure your cash is in a safe bank. So, of course, the question was, well, what's a safe bank? So, I started, it was a great question. And I wasn't prepared to start doing the research yet, but we started looking into that. And I was about probably by now, it was about 5 years ago that I hired a banking analyst and we started pouring through the financial statements of all the major banks. And that's when I started to get the crap scared out of me. When you start pulling away the layers on these financial statements, and then we started looking further down. There's about 4,700 banks in the country, and our initial goal was to come up with the top 15, or what we viewed as the top 15. If I told you, it was maybe about 6 years ago, because I remember it took us about 2 years of work to come up with that top 15, because we would open up financial statement for a bank. And, we'd notice there are the same red flags that we're seeing throughout a lot of these banks. And, whereas in 2007, there was one major issue, which, tanked the financial industry. Today, there are 6 major issues that are on bank balance sheets right now. 6. So when everybody is talking about how much healthier the banks are today, excuse me, I think that's a lot of horse manure. Banks today, the balance sheets are shakier than they were in 2007. So we started peeling back, looking at one, then another, then another. It took us 2 solid years of work to come up with those 15 banks. And it was because the significant majority of banks have at least one of these red flag issues. I'll just basically go, just note what these risk factors are, and you'll commonly see this on most banks when you pull apart their balance sheets if you know what you're looking for. For example, everybody knows today commercial real estate. Everybody knows today, there's an issue of commercial real estate. We're now hitting up against the 2027 refinancing wall. And this is going to trigger a very deep issue in the commercial real estate world. And we've only seen really the tip of the iceberg on that. Another issue is consumer debt. The risks of consumer debt right now are approaching the 2007 levels. Then, when you look at what banks hold as their major collateral, major collateral they hold are long-term securities like treasuries. But most of them are underwater. They were all purchased when treasuries were just north of 0%. They were under 1%. And a lot of them are now majorly underwater. So if the banks ever have a liquidity crisis, they're going to take massive losses on what is considered one of their major assets. Another issue that has always been an issue that really has never been dealt with, or over-the-counter derivatives. And to be honest, no one person can really get a handle and quantify, just how deep an issue the derivatives may be, especially when we go into a liquidity crisis. Another issue that is becoming much bigger now, and we started talking about this issue years ago, high risk shadow banking. The lending, we're all hearing stories about, the lending has exploded. And now we're starting to hear some stories about how you see cracks in that armor for the shadow banking industry. And then, there's one last issue that we see quite commonly, and that's an elevated default risk in commercial and industrial lending. So, I mean, you have these 6 issues that are now sitting on bank balance sheets. And, one can probably cause a huge snowball effect throughout the industry that can then, start bringing the others in. So when one starts cracking, the others will likely follow like dominoes. And, there are a number of banks that, especially a lot of the bigger banks, have all 6 issues sitting on their balance sheets. I mean, I look at banks like Citibank and Capital One, and the old statement, what's in your wallet? I'll tell you, you don't want those in your wallet, or you don't want them holding your wallet. So, that's what I'm seeing in the banking world. And, the scary thing is most people don't understand the relationship that they have there with their bank. They're a creditor. When you open an account in the bank, they owe you that money. You can't just walk up and ask for it and thinking you're automatically going to get it. If the bank's having problems, you're going to stand in line with all the other unsecured creditors because that's all you are. You're an unsecured creditor. So most people don't understand the relationship they have with their bank, and most people don't understand what the balance sheet of the bank that's housing their hard-earned money really looks like. And if you do look at it, be prepared to potentially be scared.
Can I jump in there, Avi? I've
Sure.
got several points, and maybe I can just list the points, and then you can address, any of them or all of them, however you wish. What you said about the bank owes you the money. The first question is just a practical one. Is that true of savings and checking? Is it true of CDs? In other words, is there a differentiation among the type of deposit you have with the bank? The second question is,
Can we do one at a time? Let's
okay,
handle one at a
sure.
time. Okay. With the answer to that question is yes, you are an unsecured creditor across the board.
Okay. Now, you mentioned about treasuries buying them when interest rates were low, so they're losing money. Am I correct in thinking that a lot of the assets on the bank balance sheet, such as treasuries and even real estate loans and so on, don't have to be marked to market? And so we don't see a slow deterioration in the bank's health. We suddenly see it all at once when they can't extend or pretend anymore.
Yeah, it's 1000% correct. When the bank, and ultimately, I think we all know it's eventually coming, but when the banks start having liquidity issues, people say, well, you hold the treasury until its maturity and then you're okay. But what happens if you can't hold the treasury till maturity and then you need that liquidity and you need that asset? You need to get rid of that asset to raise some liquidity. And they're going to be in for a massive loss when they have to start trading in those treasuries for cash to meet their liquidity needs. So 100%, we don't see it, but when you know that banks are holding long-term securities, you know when they were bought, and you know where those securities are worth today. So whether they mark to market or not, I think all you have to do is look at their long-term security holdings, and I think you can figure it out.
Yeah. Well, we manage money, and most of our fees come from performance fees. I joke, I wish we didn't have to mark to market some months. Two other quick questions. Well, the next question is, I'll answer both at the same. I'll ask both at the same time, if I may. A lot of people say to me, "Yeah, banks, whatever. I'm FDIC insured. It's fine." And then the subsequent question to that then is, what can an ordinary investor who doesn't have the bank analyst on his staff and doesn't have the time and dedication to devote to this as you do, what can an ordinary investor do to make sure his money's at a safe bank? And if your answer is self-serving, so be it. Whatever's the best way for an investor to protect himself.
Well, let me start with the first question, and that is there's the SPIC and the FDIC, and everybody thinks, well, you know what? That's fine. I'm covered. Well, what happens if you have a real banking crisis? When I say a real banking crisis, I mean, I look at what happened in 2008, and I know everybody freaked out about it, but if you look at it from a larger historical perspective, you realize that that was really a very short term, a relatively short term banking crisis. That lasted a year and change. So, that's in the annals of history, that is a relatively short banking crisis. What happens if we go into a protracted banking crisis, similar to what was kicked off by the Great Depression? And people say, well, today is different. It's always different. But, but at the end of the day, if we, and I'll tell you why I say this I'll explain to you this, why I believe this will be an issue of a long-term banking crisis. But if you get into a long-term banking crisis and you have one bank after another that can't meet its payments, can't meet its obligations. And you get to a point where everybody is so certain the government is going to step in either through FDIC or bail-ins, they're 1,000% wrong. First of all, bail-ins are no longer likely going to happen. When we saw what happened in 2010 in Cyprus, and if you understand what happened there, you will understand it is coming to our shores here, and it is only a matter of time. What happened in Cyprus was there were two major banks. And during the European debt crisis, both banks were about to go under. And they were waiting to see if the government was going to bail them out. Government did not bail it out, either of them out. So one of the banks went under. The second bank did something very creative. It took the assets, basically all their depositors' money, and they took a significant percentage of it and reorganized the bank with that liquidity. So the depositors, you had $100,000 in that bank. Well, that was yesterday. Today, you may have $25,000 in cash in that bank, and $75,000 you've now been given shares of your new ownership in the bank, which you can't cash out for X number of years. So while they were protected to a greater degree than the first bank that completely went under and people only got cents on the dollar if they were lucky, you're still in a very different position than you were before. And that's what's coming to the United States. We're not going to have bail-ins here. Now, when the FDIC gets to a point, the SPIC gets to a point where they can no longer handle it. Remember, the first banking crisis that only lasted a year and a half, the FDIC went negative by $30 billion. Most people don't realize that. The FDIC fund, their DIP fund, their deposit insurance fund, went negative into the tens of billions of dollars. And that's only after a year and a half crisis. What happens if we go into a prolonged crisis such as that? They will not be able to backstop everything. It's inevitable. They will not. It's great that we have trust in it. And in God we trust, in the government we trust, yes. The problem is when that trust eventually breaks down, when the rubber meets the road. So if you're going to rely on FDIC insurance, God bless you, because I think you're taking a very big risk. That's my opinion. Many will disagree.
Yeah, you need trust with verification, clearly. Now, there's two sides of that, though. You look at what happened in Cyprus, and some people say, that's probably the best scenario. Those people made the decision to be with that bank, and whether it be right, wrong, or indifferent, they suffer the consequences and they have accountability and responsibility for those decisions versus the bail-ins. I think that if I get that right, or the bailouts, whatever we had in 2007, 2008.
That was the bailouts.
Yeah, the bailouts where we had banks that made bad decisions and people who did not choose to work with those banks suffered the consequences.
Well, I mean, you have to look at it really from, I look at it from an individual's perspective.
Mhm.
I have money in this bank. I have all my life savings in this bank. I expect to be able to use my cash when I want to, which is what everybody's expectation is. And now you're at a point where, well, now 3/4 of the money that I work so hard for and that I expect to be there when I need it is no longer there. I'm getting shares in the bank instead, and I'm locked out of selling it for 5 years. Oh my God, that is a very, very different scenario. And that really is the scariest side of it, especially when you're dealing with a lot of the retirees. I mean, it's a very scary situation. And me personally, I would much rather, I go back, I learned a lot about the Great Depression. And I take a lot of my my history lessons from the Great Depression. And when we look back there, we realize that, they had over 10,000 banks, more than that even during that period of time. It was a really significant number of banks they had during the Great Depression. They had tens of thousands of banks. And at the time, I think 60% of the banks came through, which means 40% of the banks went under. So, if you're looking at a situation that could be similar to that, you have to consider, well, can the FDIC and the SPIC really stand behind if 40% of the banks are going to go under?
I don't see
So,
Um,
you have to take lessons from history. They say history, I think was it Mark Twain that said history does not necessarily repeat, but it does rhyme.
Yeah.
Yeah. Avi, you mentioned Cyprus, but we've got a couple of questions come in. Have you done any work on global banks? And particularly, we've got a question on us. How do you view Swiss banks now? Are they safe? Are there any safe banks in Australia?
I will say that we've done research when we expanded our research from the United States. We did the first top 15, and then we went to heavily populated and started finding the best banks we could find in heavily populated states. And then for anybody that's in California, you guys are SOL. There are no good banks in California, believe it or not. But then from there, we went on to Canada. And in 2008, the Canadian banks went through that crisis like gold. I mean, they came through that so strongly because they were strong banks going into that scenario. Today, it's exactly the opposite. The top banks in in Canada are in serious jeopardy. And then we started going to the Eurozone. And we started looking at the Eurozone banks. So we're not looking at banks specifically by country. We're trying to identify what is the most solid banks across the Eurozone. So I can't say that there's one particular country that stands out more than others. We look at it on an individual basis.
I think I'm right in saying that all banks in the EU are subject to the bail-in laws, aren't they?
I believe most of those countries have passed those laws already.
Yeah, that's the Eurozone, though. That's not Britain. That's not Switzerland. Just to be clear. Yeah.
Yeah.
Rich?
I just want to do one bit of housekeeping before we move on. There were a couple folks raised their hands, said, "Hey, I can see Rich and Adrian." Sorry, gentlemen, for that, or ladies, but can't see Avi. And just so you know, that is by design. We're helping Avi keep a promise to his first wife that he would not, appear with an image. So, but he is there. I can assure you that before we went live, Adrian and I both saw him. He is dressed, and he is still a wealth of knowledge. So we've got him with audio tonight.
Okay. And, there's another question. Let's jump to this one right now. And that is, are the big insurance companies such as New York Life, MassMutual, are they any safer than the banks?
I haven't done any heavy research on insurance companies, but my expectation would be they would not. They have been chasing yield for years. And as they've been chasing yield, they have gotten more and more aggressive. And
They've had to, right?
they've had to. When you go aggressive, it most likely means you have done some damage to your balance sheet. But like I said, I haven't done any detailed work on insurance companies. It's just my guesstimation.
Yeah, and I think some of them are big into private credit, but I'm not sure about New York Life, but certainly some of them are very big into private credit.
And
which is
one more question as well, to differentiate credit unions.
Okay, that's a good question. We cannot answer about credit unions because there is no public information on those credit unions. We can only analyze banks that offer information publicly. So credit unions that don't offer their information, their financial statements publicly, well, we cannot make any assessments on that. But if you are in a credit union, I would strongly recommend that you do some due diligence on what they're holding. If you're looking for due diligence guidelines, we developed a site Once we came up with our top 15, we rolled out a service called Safer Banking Research, saferbankingresearch.com. And in the free section, we have tons of articles of how we look at banks, a lot of the big banks and how they look. We have a bunch of articles on the major issues that are being seen in the banking world and how they've been developing over these last few years. And one section we have that outlines our methodology as to how we review banks. So you could take our methodology and just apply it to your credit union if you'd like to. But we offer all of that free on this website.
Avi, you mentioned that Canadian banks today are in worse shape than they were in 2008. And since you made that comment, I think in fairness to our Canadian listeners, bonsoir, Eric, comment allez-vous? Eric asks, why are you saying Canadian banks are not in a strong position today?
A lot of that is because of the inflated real estate issues.
Okay. And is it commercial real estate or all real estate?
All the above. I mean, I don't remember the specifics when I haven't looked at the Canadian banks in some time, but they have very similar issues that they're dealing with in Canada right now. Whereas, like I said, in 2007, they looked beautiful going through that crisis. But in right now, their balance sheets are much weaker.
Okay.
Avi, I wanted to spend a lot of time on this topic up front just because I know it was important to you. There's one more question here, and then we might want to switch gears a little bit. It says, what's your timeline on the banking?
That's a great question. I am actually, my expectation, I thought that by now we probably should be entering the bear market, but the overall, once I believe this is all going to come to light once we enter into the next bear market. And I mean bear market like similar to what we saw in 2000 to 2009. If you look at a long-term chart, you will see 2000 to 2009 was basically a sideways market where the market oscillated between 1,500 down to as low as 6,600. I'm sorry, 666. So 1,500 to down to about 666. And the market just oscillated back and forth between those 9 years. We're looking for a similar type of bear market to begin, but on a much grander scale. Once that bear market begins, I think you're going to start seeing all the rest of the dominoes starting to fall in the banking world, and the banking world may even lead us into that. I always say I am a simple analyst. I'm not a prophet. I'm an analyst. So, there's only so much, some of my clients ask me questions that they give me way too much credit for when they ask me these questions. There's only so much I can foresee. We are tracking the stock market on a daily basis, and we have no indication yet that the bear market has begun. Or that a major top has been struck yet. My expectation is we are, from a very long-term perspective, we are definitely in that zone right now. But there's clearly no indication yet. And one of the other charts I'm tracking very closely is what they view as the granddaddy of them all, the strongest big bank out there, and that's JP Morgan. And it may be the strongest of the big banks. Doesn't mean it's a strong bank. So I'm tracking JP Morgan on a weekly basis, and we have a support level that we're watching on JP Morgan, which we actually recently struck. We hit that support during this last pullback in the market. So if that support breaks, that's going to be an initial indication to me that we have to start really watching that banking industry very carefully.
Rich, I think you said let's move to the markets after this. Judging from the questions we're getting, I think
we may not ever get there.
We could have spent the whole evening on the banks, but let's move to the next topic. Let's talk about markets. And if I may, Avi, I would like to start, before we talk about specific markets, I would just like to ask you what your approach is. Obviously, there's something about Elliott Wave in your title. So you look at fundamentals at all? Is it all technicals? And if it's, do you look at different forms of technical, or is it all Elliott? And maybe just explain your approach to us.
That is a great question, and thank you for asking that. Well, I start, as you mentioned earlier, I started my career with economics. I was trained in economics. I was trained in accounting. So not only did I understand economics as it applied to finance, I also understood the world of finance through the accounting world. So when I came out of college and I was looking to start investing, I'm like, yeah, I got this. I take apart the fundamentals. I know what I'm doing, so on and so forth. And a number of years go by and I realize, wait a second, I'm no better than anybody else out there. I have great education. I'm an economics major. I really learned the stuff. I understand it backwards and forwards, and I'm not doing any better than anybody else. What am I missing? What is the missing link? So I started going down the path of learning different technical methodologies. And I would learn this methodology and that methodology. And, I just was never fully satisfied. There was always something missing to me. Finally, I came across some Elliott Wave general theory articles, and that really started intriguing me. Why? It seemed like it was the missing part of the puzzle. Ralph Nelson Elliott, back in the 1930s, identified that the market is not necessarily driven by the same factors everybody believes. Rather, the market is driven by sentiment, public mood. And that public mood or sentiment is actually patterned. It moves in a 5-wave trend. Waves 1, 3, and 5 move with the trend. Waves 2 and 4 are counter trend. And he explained how, overall societal sentiment can be seen through the stock market. Why is the stock market a great barometer? Because people will act on their sentiment instantly by buying and selling stocks. So the stock market is the best gauge for societal sentiment. So when I started learning more and more about how Elliott Wave worked, it really seemed to me the missing part of the puzzle, the psychological driven side of the market. Now, does that mean I have completely abandoned fundamentals? No. I think there's a place for fundamentals, but I want to be very clear about how I see that. And that's on a continuum. All the way on the right side of that continuum, you have these mega cap stocks that are similar to the SPY or anything big with massive volume. Anything with such high volume is going to be a great example as to how sentiment drives it. Sentiment drives the bigger volume stuff. Because if you have more of society participating in something, then you have more of general societal sentiment being seen in those charts. Now you go all the way to the opposite end of the spectrum, and you get a micro cap, like micro cap biotech company that's coming out with one product in their line. Well, sentiment is not going to help you with that. You're going to need to know the specifics of the fundamentals on that specific company. Sentiment will not help you. Now, that is a very large range in that line. Where you fall within that really is going to depend on the volume you see in that's trading in that particular company. So when you're dealing with a massive market like the S&P, if you're dealing with a massive company like Tesla, it's going to be driven by mass sentiment. If you're going to, and then along that continuum is going to depend on how much volume that specific stock is trading on. The further down the left side of that continuum you go, the more you need to understand the fundamentals. The higher you go on that continuum, the less you really have to worry about fundamentals. So it's really on a continuum basis.
Oh, that's a really interesting answer. And, talking about sentiment, Elliott Wave generally, and I've listened to Bob Proctor several times, discuss what I'll call societal sentiment, whether it's dress or music, and how that, I won't say affects, how that plays along with sentiment in the stock market.
Bob is, from a theory standpoint, Bob is the best in the world when it comes to this. He wrote a book called the Socioeconomic Theory of Finance. And it is a book that I cannot recommend more strongly to each and every serious investor. the socioeconomic theory of finance. The first 2 chapters alone are worth the price of the book. The book will blow your mind because what it does is it takes all the clouds away from most of the fallacies that are propagated through the market today. And most of what you believe today in the market are based on fallacies, sadly. But Bob just takes it all away and just goes to the heart of the data. And that is really what he focuses on and pulls all of this fallacy away from market paradigms. So Bob is the best when it comes to the theory. And basically the way a socioeconomist views markets in general is that societal mood not only will govern how markets move, because the mood is what determines people's willingness to take risk or not take risk, but that same mood will affect, well, do they want to listen to this type of music or that type of music? Are they willing to be more free in their dress or more conservative in their dress? The same societal mood affects clearly society and what is made, all the decisions made throughout society. So it's really a very universal theory that, when taken as a whole, really, as I said before, is the missing link that we can use to understanding markets in a better way.
Appreciate you asking that, Adrian, and fantastic answer, Avi. So now the big reveal, and I know Mike is asking for us to go ahead and jump right to gold and silver. We're going to get there. I told Avi we have a lot of interest in our audience with gold and silver.
Sorry, I know nothing about gold.
Oh, please. Let's go ahead though. Start with the stock market. With your thoughts on the S&P 500.
Well, people that have been following me for many years may remember my market calls from when the S&P was in the 1,500 to 2,000 region, and I said, minimally, I'm looking for 4,000 on the S&P with my ideal target range between 5,300 and 6,000. And I started saying this close to 10 years ago. And, we the market crashed during COVID, and I was telling people, we're down to the target we had for this crash. We actually called the crash before anybody even heard the word COVID. We called for the market to return back to 2,200 on the S&P, and the low that we struck, I think, was 2,187. So I think we were off by 13 points. But we were telling people, buy, buy, buy. But everybody was scared. But we saw that as just a fourth wave correction within the larger degree Elliott wave structure, leading to a fifth wave rally. My minimum target was 4,000, ideal target 5,300 to 6,000, and we've clearly surpassed that. And now there is potential that we could see us getting up to the 8,000 to 8,500 region before this long-term bull market completes. So we're watching that very carefully. I think over the next weeks to maybe month or two, we'll have a much better idea if we can get to that 8,000 to 8,500 region. But ultimately, when you look at a 100-year chart, and I'm following this on literally 100+ year chart of the S&P when I'm dealing with Elliott wave analysis, we are literally in the final stages of a very long-term bull market. I'm going to give you just a quick story. Back in 1941, Ralph Nelson Elliott probably made the best market prognostication that I've ever seen anywhere in history. In 1941, what was going on in the 1940s? We were in World War II. It was probably the greatest negative sentiment period in recent history. And when I say recent history, I mean over the last 150 years. It would probably well exceed even that of the Civil War here in this country. So, we're during a period of major upheaval. We're going through the Great Depression. We're entering into a major war. I mean, people were really very negative. And at that time, Ralph Nelson Elliott called for a 70+ year bull market. 1941, he was calling for a 70+ year bull market. Now, I'm standing on the shoulders of giants when I say we are now coming to the conclusion of that bull market that Ralph Nelson Elliott called for back in 1941. And that is my fear. I'm probably the only analyst you will ever speak to that, I'm a religious Jew and I pray every single day, 3 times a day. And every time I pray that I am wrong in my view of the market. I have 6 kids. I don't want them to have to go through major economic upheaval. And I think it's going to be at least a 10 or 11-year bear market. I think it could be as long as a 21-year bear market. And that being the case, I don't want to have to see my children struggling through something like that. So I pray every day that I'm wrong. And I'm probably the only analyst you'll meet that prays every day that he's wrong. But I'm always looking, where can I be wrong? Where can I be wrong? I'm always challenging my analysis. Where can I be wrong? And I'm not seeing anything right now that is telling me that I'm going to be wrong in this very long-term assessment.
Well, you obviously know that fabulous graphic that Bob Prechter put together that shows, it dots the fundamental metrics for the S&P going back over 100 years. And I can't get the numbers right. You're going to correct me, but it's something like up until 1988, there were only like 3 outliers from this box of valuations, and 2 of them were on the downside. Since 1988, it's been 90% of them have been above, the valuations have been above that long-term 100-year average. You know the graph I'm talking about, Avi, right?
I know the graph, and it's all based upon, Bob always says the fundamentals will always look best at market highs. And I think there was another gentleman, I think it was a former World Bank head economist that also put out an entire article about this, that, if you're trying to utilize fundamentals to identify turns in the market, you're going to fail. Fundamentals always look best when the market's about to top, and they always look worst when the market's about to bottom. I mean, look at the fundamentals that we saw back at the COVID low. Economic shutdowns, the worst of the death rates being reported. The highest, you had massive unemployment, record unemployment, yet the market is screaming higher when this is going after it hit its bottom. So fundamentals always look worse at the bottom and best at the highs. And I think that's the point Bob was making with those charts.
That's true of sentiment as well, though, isn't it?
Sentiment, absolutely. But the thing about it is you have to identify when you're reaching the end of that sentiment trend. And that's where the Fibonacci mathematics come into the Elliott wave analysis. It tells you where you are in that 5-wave trend and gives you a very good probabilistic view as to when you're going to turn. Fundamentals can't do that. Fundamentals are looking at the market more so in the way of a trend channel. At least that's how I see it.
Yeah. Well, we could spend all night talking about that as well. But Rich,
Right.
Question.
Yeah, so I want to. I know Mike wants to get into gold and silver. We're going to do that here in a second. But when we did our short little interview, a couple weeks ago for our newsletter, you were gracious enough to do that. You said something that you said you're going to shock most of our listeners because you were talking about the potential return or reemergence of King Dollar. Why don't we touch on the dollar? Because there's a lot of talk right now about how I talked about that this morning on my video, that everybody's saying that the dollar is putting gold under pressure right now. And I honestly, right now, I don't see it. Okay, because it hasn't got out of 98 and change on the USD Legacy Index, Dixie. But you think long term that we may see a reemergence. I'd like to hear your thoughts on the dollar going forward.
Yeah, you hear a lot of, and as we were standing at the lows, all I was hearing is the dollar is dead, the dollar is dead, the dollar is dead. And I'm pounding the table that we are hitting a major low right now, and I think we could see a massive rally in the dollar. So much so that I have a long-term target of about 120, 122 on the Dixie. And I will know whether we're going to achieve that based upon the manner in which we rally off this recent low that we have struck. I'm looking for a rally up towards the 106 to 110 region first. The nature of that rally will tell me if my initial assessment is correct. If we rally up to the 106 to 110 region on the Dixie in the coming months, in a what we call an impulsive fashion, a five-wave structure, then that will portend we'll get a corrective pullback thereafter, and then we're going to get a massive rally up to the 120, 122 region, the Dixie, over the next decade. So yeah, most people don't believe that, probably can't even conceive of those type of numbers, but I will tell you, we saw a similar type of setup back in 2011. In 2011, the Dixie was hanging out around 73, if I remember correctly. And I remember I put out one of my first public market calls, and I said, well, the dollar is dead, the dollar's dead, the dollar's dead. Everybody's saying quantitative easing is going to kill the dollar. And I'm looking at my charts and saying, I don't think quantitative easing is going to do anything to the dollar. I was looking for a target of 103.50 or something like that from 73. And people thought I was nuts. But on that rally that we got to, I think I was, when we finally hit my target, and before we got a big correction, I think I was off by about 23 cents on the Dixie with my target. But I'm seeing a very similar type of setup right now in the Dixie. Dollar is dead, dollar is dead, dollar is dead. Everybody has their fundamental reasons why the dollar is dead. We said we are hitting a major low right now. Depending on the way we rally to 106 to 110 will tell me if we're going to be continuing over the next decade to 122.
We talked, I struggle with this because, I look at, again, the reality of what's going on in DC. We can't balance a budget. We're approaching 40 trillion in debt. And I'm like, the world is pulling away from the dollar with weaponization and everything else. And I see all those things playing out. And I'm thinking to myself, how on earth could the dollar be strong? But it can be strong against other currencies, can it not?
I don't look at it, like I say, from that fundamental perspective.
Yeah.
Because a lot of that perspective is looking at, well, what is the environment today? Well, the environment today is not going to be the environment of tomorrow. Just like quantitative easing in 2011, when we were calling for a major low in the dollar, was not going to be lasting forever. So, I view that as more noise than anything else. I like to focus on what is sentiment telling me. Sentiment in recent weeks was telling me the dollar is hitting a major low. And the question then is, am I going to get the sentiment pattern that I want to see that's telling me we're about to see a massive move in the dollar? Or is it just going to be a corrective move up to 106 to 110, and we're just going to be meandering between 90 and 100 for many years to come?
So let me go back to the stock market, but based on that thought you just had, but go back to the stock market. You gave a fairly a specific, but a reasonably broad range for where the market might go, given that we're already over 7,100. What would you be looking for, and what should we, the audience, what should investors be looking for to say, yeah, we're going to shoot right up to 8,000 and beyond, or wait a minute, this 40-year bull market is actually reaching an end? What should we be looking for?
For me to answer that, it's going to be more of a technical answer that may confuse more people than enlighten people. It would entail a very detailed Elliott wave answer.
Okay.
How to simplify that? Where we are right now, I would say that if you, to simplify the answer, I would say that if you see us breaking down below 61.75 on the S&P, that probably is a very strong signal that we may be beginning a very long-term bear market, especially if that breakdown happens very, very swiftly. From an Elliott wave perspective, since 2022, we have been in what we Elliotticians call what seems to be an ending diagonal. One of the hallmarks to an ending diagonal is that oftentimes you have a spike up to complete it and an equally stronger, if not even stronger, spike down reversal. And you return to the region from which that ending diagonal began. In our case, that ending diagonal began between the 3,500 to 3,800 region. So if I'm looking at a much bigger perspective, I will tell you that if you see us starting to break down quite precipitously and over months, we're going to get back down to the 3,500 to 3,800 region. That's very clear telling you this long-term bear market has begun. You will then see a very long corrective rally after that. That'll probably take you back to the 6,000 region. And that'll probably be your last opportunity to get out of equities.
Right.
But I will tell you, if you see us basically crashing down to the 3,500 to 3,800 region, which I know everybody is thinking to themselves, that's impossible. Okay. But if that's what you see, then you have a very, very strong indication that a very long-term bear market has likely begun.
And I guess listening to you, what I would then say to an ordinary investor who's relatively conservative, a long-term investor, not a daily trader, doesn't have time to really focus on this. What I would say is if your upside is reasonably limited, but we're looking at an 11 or 21 year bear market, but could lose, I'm not putting words in your mouth, could lose 2/3 of the value, then the investor that I described should maybe say risk reward. I should be starting to lighten up my positions now and forget about missing the top.
I will tell you that I don't disagree. So much so that I agree with you that right now I am personally in my heaviest cash position in my career, in my entire investing career. I'm sitting with about 80% cash right now. I am willing to take probably half of that. And I say 80% cash in just my trading accounts.
Wow.
I have cash outside of that, of course, in the safer banks. But within my trading accounts, 80% of my trading account is now sitting in cash, and I'm waiting to see what happens as to what I do with that. I may take half of that and put that back into the stock market if we get the setup to go to 8,000 to 8,500. I'll play that next 20% higher, and then I'll get out again. But right now, until I see that setup develop, right now I'm personally sitting in the highest percentage cash I've ever held.
That's interesting. And of course, Chuck Prince famously said, keep on dancing, but make sure you're dancing near the door. And the problem with that is if everyone's dancing near the door, not everyone can get out.
Exactly.
Yeah. Rich?
And, it's funny because along those same lines, I tell my clients all the time, unless you have traded during periods of liquidity issues, I'm talking about, during the 2008 decline, if you haven't traded during the flash crash of 2010, if you didn't trade during the COVID crash, you don't understand that, trading platforms freeze up.
Yeah.
You could try to get out and you won't. I've even told some of my clients, you could be on the right side of a put and you could not cash in on it.
That's right. And beyond that, of course, is a person's own psychology. Some people freeze, forget the machines freezing. Some people freeze when you have a 1987 crash and they're just staring at their machine all day long, but they're not doing anything, which might be the best action, but
well, the worst part of it is I think what the Fed has done, and I think they've created a moral hazard by what they've done. They have made people believe that they can direct the market, so much so that people now believe the market will always come back. And that's based on a recency bias. I'm sorry. From a long-term perspective, that is based upon a recency bias. Go tell the people in Japan that have gone through a multi-decade bear market. The market does not always come back. It may be in recent years that's been our experience because that's how the market has reacted. But we are heading to a period of time, and from a probabilistic standpoint, it is a high probability we are heading into a period of time where the market will not be coming back and making higher highs as we have experienced over these last 20, 30 years, as we've seen with the Fed. We're heading into a different period of time. That will no longer be the case.
That's a good point, and I'm glad you raised liquidity because Mike, now is your time. We're gonna make this switch over to gold and silver. You know, gold and silver have come down over the past couple months. We've seen a correction. I think everybody on this panel probably agrees that that was overdue. But I think part of what's going on with gold is the need for liquidity. Where do you see gold and silver? Here we come, Mike. Where do you see gold and silver going
I,
forward?
I right now I don't see this correction as having completed. The rally that we've seen off the recent bottom is a very, very corrective looking rally is probably the best way to put it. It is a corrective looking rally. Corrective rallies usually set up for lower lows. My expectation is that we will get a lower low, at least from a probabilistic sense. I keep saying everything that I talk about, and I just want to remind everybody, everything I talk about is based upon probabilities, probabilistic perspectives. There's nothing, there's an old joke. I'm a former tax attorney, and there's an old joke that people say, the only thing that's certain in life is death and taxes. Well, tax attorneys had a joke. The only thing that's certain in life are death, taxes, and tax reform. So, but there's nothing certain in life. So I speak about everything from a probabilistic sense. From a probabilistic sense, we are going back down towards that 3,800 to 4,000 region. And I think once we get there and we complete the structure, I think that will be a phenomenal buying opportunity in gold. However, I'm going to caveat that. If we move into a correction similar to what we saw in 2011, and I will tell you there are a lot of similarities between this correction and the one we saw in 2011. If we move into a similar type of correction, then the rally off of 3,800 to 4,000 will be corrective as well and set us up for another drop in the years to come. That drop could be as deep as the 2,000 to 2,500 region. And that will be a phenomenal opportunity. But there's no way I can make that determination right now. As I say, I'm an analyst, not a prophet. I will have to see how we rally off of that 4,000 region to make a determination about that. Same thing in silver. My ideal target right now on silver is about the 53.50 region. That would be a great. I remember years ago, I would bang the table to all my clients and I say, guys, you get to purchase silver under $20. That is a phenomenal opportunity. Phenomenal. Below $20, phenomenal opportunity. I have now moved that bar. Anything below $60 is a phenomenal opportunity. So because of where we are, both are in a very long-term bull market, but even during long-term bull markets, you have intermediate bear phases. We are in an intermediate bear phase right now. And again, I don't know if we're going to head back into the bull market sooner rather than later. I have to watch how we rally off the expected lows that I have.
Avi, when you talk about the similarities between, if I may, the similarities with the gold between now and 2011, are you talking purely about market action and not about fundamentals?
I'm talking purely about their structure. Yes.
Okay. Okay.
The market, Elliott explained to us, the market is fractally based. And then, decades later, Mandelbrot came out and told us the same thing. And, both of them showed us how this is so, from a mathematical standpoint, but very different perspectives from their mathematical standpoints. Elliott came at it with the Fibonacci perspective. Mandelbrot also built upon that Fibonacci perspective and came up with his Mandelbrot set. But they both outlined to us that life, as well as the stock market, is fractally based. So I'm seeing a fractal that occurred during the 2011 start to the correction in metals, and we're looking very similar from a fractal standpoint. It's a not carbon copy, but very similar copy to what we saw in 2011 and going forward. So that's why I'm watching very carefully.
And do you look at the mining stocks, whether they're producers, royalties?
Oh, we analyze, oh my God, hundreds and hundreds of mining stocks. But from a general standpoint, and they're all, oddly enough, there are two different camps right now. And it's not based upon the type of stock they are or where they are in the complex. It's based upon their structure. There are two camps right now. One is a camp that is clearly in a corrective phase that's going to last quite some time. And then there's another set of stocks that seem to need one more drop to complete a smaller corrective phase, and then we'll head to much higher highs. So we're actually looking at, sorry, that's the bell at 8 o'clock. We are actually looking at the mining stocks as being the best opportunities going forward, because we're still questioning whether silver and gold will be in a longer term corrective phase in this very, very large bull market. But a lot of the mining stocks are much more likely to be, once we get a lower low, are much more likely to be rallying to higher levels. So we're more focused on the general mining index as a whole.
Does that include, copper, uranium, oil and gas, for example?
I would say more so. I'm talking more so the metals.
Okay.
Talking more so the metals, the common metal stocks.
Okay. Do you have a view on oil and gas?
Oil, my opinion is that I think oil is going to be coming down in a very large corrective state to even levels that we saw below last year. And I think you're going to get another tremendous buying opportunity in it. But the long-term structure in oil is probably the most convoluted of all the charts that I track right now, all the major charts I track right now. Oil is probably the most convoluted. But my expectation is over the coming maybe couple of years, we're probably going to hit lower lows relative to what we saw last year, and that'll be a tremendous buying opportunity.
Okay. Rich?
Yeah, so I think we've covered the things that we wanted to cover with Avi at this point. You want to switch to questions at this point, or do you have something else, Avi, that you want to touch on before we do that?
Let's go to questions. It usually brings out a lot of great stuff.
Can I just ask one more question, if you don't mind, before just based on what you were just saying about oil? Do you often just look at your charts and from your analysis say, gosh, I really don't know which way this is going. It's just too messy, too many divergent views, and I just can't make an assessment?
100%. I tell all my clients, and what my clients, a lot of them say what they love about me is that I will tell you what I am seeing. And if I can't see something, I'm going to tell you that too. I will tell you, your money is better served elsewhere. Don't focus on this chart until the chart becomes a little more clear. So 100%. If I see something that is not clear, and I can't make a strong probabilistic, provide a strong probabilistic analysis for it, I will tell my clients, guys, your money is better served elsewhere.
Okay, well, fundamentalists and Elliott Wave agree on that. Sometimes you just don't have a view, right? You don't have a view, so
it's impossible. And everybody that tries to come up with a view all the time, I don't think it's honest.
Okay.
I saw one question pop up. I don't know where it is exactly, but they basically said, what's the short term or what's the potential target for gold after this short term low?
Again, it's all going to depend on whether that rally will be corrective and it won't make a higher high, or if it will be impulsive. If I get a 5-wave structure off that, then I could start calculating based upon that 5-wave structure, depending on how long it is and so on and so forth, historical standards. I really cannot. I can't come up with an answer right now. Most of my stuff is based upon mathematical calculation.
Gotcha. And I'm seeing there's questions both in the chat and the Q&A, so I'm jumping back and forth between them at this point. And that's why I saw that pop up. And
by the way, let me just interrupt you 1 second.
Yeah.
I would say that 7,000 is not an unreasonable target if we're about when we do start the next major bull phase in gold.
Gotcha. So Chris came in and said, do you use time cycles in your analysis?
Great question. for decades. I've studied markets for decades, and I have studied all different methodologies. And, of course, projections in price, if you can couple accurate projections with accurate timing, that's the holy grail of market analysis. I've done so much studying on timing cycles to get to that holy grail, and I have not found anything that is greater than 50%. In fact, I have seen timing analysts, I'm sorry to say, probably hurt their clients more so than help, because I've seen more timing analysts cause busts in their clients' accounts more so than probably any other analysts out there. But from a timing perspective, I have never seen anything that's greater than 50% accuracy, and I can't rely on something like that.
Okay. Next question. So I think these two are related. If the dollar is going to get stronger, is TLT a bad bet? And then should we exit long-term treasury since dollar is likely going up?
That's a great question. I don't do intra-market or intermarket analysis. I stay away from that, because what that really is just based upon correlations. And if you understand what a correlation really is, at least from an Elliott wave perspective, you really know to avoid it, because until you can actually make a determination as to when the correlation will break, you're pretty much flying in the dark here and just assuming that it's always going to be held at the standard that it is now. And we know markets are not linear. Markets are non-linear. So those correlations ultimately will break. Elliott wave gives us a great perspective as to why correlations exist. And where each chart is in their particular pattern tells you exactly when that correlation is going to break. I'll give you an example. Back in 2015, I wrote an article publicly. No, I'm sorry. I did this analysis for our clients because a lot of our money managers were asking this question about a number of the correlations that existed at the time. And I said, from what I'm seeing, many of these correlations are about to break as we move into 2016. I remember one of my clients, he managed several $billion in assets, sent me a message it was maybe March of 2016 that I forgot which of them. I think it was one of the major banks put out an article that said, we have never seen correlations break down like they are right now. So if you understand what correlations are, you understand not to necessarily rely upon all this intermarket analysis. But that being said, treasuries, or should we say TLT, for example, TLT has struck its very long-term high. The bull market in TLT is done. We are now in a very long-term corrective phase in treasuries and bonds. Right now, I would prefer, my expectation is we're trying to develop a low in TLT right now, and I would like to see TLT get back up to the 120 region over the coming few years. The problem is that is only going to set up a bond market crash. And that bond market crash looks to be setting up as quite severe, similar to what we saw in Europe during the 2011 European crisis. So I think we're probably heading in that direction here with rates skyrocketing. So I think we probably will be hitting, will at least approaching, if not even getting into double digits as we look out towards the end of this decade into the early next. So personally, I own no treasuries at this time longer than a year period.
Hmm. Okay.
Rich, you're the only one that can see the chats, by the way.
Yeah, well, I think people are sending questions to both of them at the same time, so I'm jumping back and forth. But the bottom line is, I think this one was from earlier, and you just mentioned bonds. Any view on corporate bonds?
Corporate bonds, all depend on how strong the underlying corporation is. That's really where it comes down to.
Okay.
So,
Fair
nothing
enough.
really to say on that.
Now this is a good one though. Where is the safe place for your cash?
Safe banks.
And one more time with that website.
Saferbankingresearch.com.
Okay. All right.
I was
And
going to
you,
say, Christian, should our guest let everybody know about his services and where to go to get his services before we, get to the bottom of the hour and people start leaving?
Yeah, I think that's probably a good point. Avi, how can people find you, reach you, touch your services, whether it be safe banking or your analysis on Elliott Wave?
well, I'm all over the net. A lot of major sites carry our analysis, but our main website is elliottwavetrader.net. We have, I think, 27 analysts that cover markets all over the world. And we like to teach what we do. So, we have beginner seminars all the way through expert seminars. And we like to teach what we do. And, you have to have at least a working, or at least learn a working knowledge of what we do to understand how we do it. There's no wizard behind the curtain. It really is all mathematically based. So we do like to teach what we do.
Fantastic. Let me see. Some of these were from earlier on the discussion. So if
While you're looking, Rich, I've got another question, if I may.
okay.
Uh, we touched a little bit, you mentioned Cyprus banks, you mentioned Japan. What is your view on, can you give a broad view on global markets right now, global stock markets, or are there particular sectors or areas that you like?
Well, I had been very, very bullish for emerging markets for some time now. Unfortunately, we're approaching the conclusion of that rally. I'm expecting a very large correction in emerging markets, then to be followed by one more major rally, and then into a very long-term bear market in emerging markets as well. But I think emerging markets may have a little more opportunity in the coming years than the US market. But remember the old adage, if the United States gets a cold, the rest of the world gets the flu.
Yes.
So
Okay. So I see this question come up, and I don't know that we answered it thus far. But how safe are short-term treasury ETFs such as BIL at a brokerage such as IB? That seems very specific.
now there are other issues with brokerages, and I think you need to do research on your specific brokerage as well. Because there have been some interesting history on how brokerages go under. So you need to do some financial research on brokerages. And by the way, as part of Safer Banking, we also analyze the major brokerages, at least the ones that have public information, to tell you which are the safest. So we do that as well. So that's the first thing I want to say about brokerages. So there is some risk just in the brokerage alone. And then if you're talking about an underlying ETF, you really have to look at the prospectus as to how that ETF has been created. For example, people ask me all the time, why can't I just buy, because I'm not a fan of GLD or SLV. So people are, why can't I just use that as a long-term play on gold? And I'm saying, well, if you read the prospectus, you would understand why. I mean, I did an entire hour-long webinar on why GLD is not an appropriate long-term investment. And I'm a lawyer. I took apart the prospectus on that webinar. And I explained from a lawyer and an accounting reason why you cannot rely on GLD for a long-term hold. You want to trade it? Great trading vehicle, not a long-term investment vehicle. So when you look at ETFs, you really have to understand how that ETF prices and how it moves to really have a better understanding as to whether it's safe or not.
Could not agree more. Great place to trade. If you're looking to accumulate gold and silver, that is not the way to do it.
Nope.
Plain and simple, period. Now, on that note, your long-term view on gold and the place it has in a portfolio. I think we want to share that as well because you could take what you said tonight and come across as pretty negative on gold and silver, but I know you, Avi, and I know that is not the case. What are your thoughts long-term on gold and silver in your portfolio?
I personally hold a lot of gold and silver. I hold it in many different ways, and that is because what I've learned from history. And I think even if you do own gold, and there's anybody of means should absolutely be owning gold and silver. No question about it. The percentage, everybody can agree about what percentage of your assets should be in gold and silver. But you should definitely be holding gold and silver over the long term. So much so that I say I will never, ever, ever sell an ounce of gold or silver that I own, and I intend for it to go to my heirs. So I view it as being in a very long-term bull market. But as I said, life phases have phases of progression and regression. It's like every market has phases of bull and bear. It mirrors life. So you're going to have bear markets. Bear markets can be viewed as opportunities if you want to add to your positions. So that's how I view gold and silver. I think it should be held for a long period of time, and I think you should have different types of gold. One of the things that I love personally about, I bought a lot of this gold when gold was below 1,100 and 1,000. I would buy a lot of, and you got them on here, the St. Gaudens, I think. Are those the St.
Yep.
Gaudens I see back there?
I think those are eagles, but that's okay.
Oh, okay.
So.
But I will tell you, the St. Gaudens, I love St. Gaudens because number one, they are gorgeous pieces of gold. Number two, if we all know our history, when they started confiscating gold during FDR's time, there was an exclusion in his executive order for all gold that has numismatic value, a separate numismatic value that is attached to that piece of gold. The type of gold we're talking today, such as the St. Gaudens, have a specific premium allotted to that numismatic value. And that was excluded in the confiscation of gold by FDR's executive order. Is that going to happen again? I don't know. Like I said, I'm an analyst, not a prophet. But I learned from history, and I say, okay, if this has happened before, it can happen again. So I hold gold and silver in various ways. For example, I own a lot of junk silver in addition to really nice pieces. And I hold silver in many different fashions, from the Engelhard bars all the way through. I mean, I think it is safe. You're safer if you're going to diversify even within the metals. And personally, I will never sell, at least I hope I never have to ever sell any of my gold, even a single ounce of my gold or silver.
That's good stuff. And I'm glad you mentioned junk silver. Folks, please stick around to the end. We do have a deal on junk silver for everybody listening here tonight. But Don asks, if the market does set up for a final move to 8,000 plus, does gold go up in sympathy before a decline, or as some have argued, or will we have the corrective rally end in a decline to 4,000 first, regardless of the market's action?
That's a great question, and it's asking me another correlation question. So I'm not going to repeat my answer before about correlations. What I will say, again, if you know your market history, you know there are periods of time where gold rallies with the stock market. There are periods of time where gold falls with the stock market, and there are periods of times where they act inversely. And it has nothing to do with the fundamental factors that people are talking about. Well, it's a safe haven or this or that. I mean, gold is not a safe haven for the stock market. If it was, it wouldn't have lost over 30% during the 2008 decline. And then people's argument to me about that was, well, it lost less than the market. Look, when I want a safe haven, I don't want a safe haven that's going to lose money. I want a true safe haven. So gold is not to be looked at as a safe haven per se because of market volatility. Gold is more insurance against what can go on in the world. You never know what can happen. That's why you have gold. It's a store of value, and that's why you have gold. Silver, I mean, so will gold go up or down? It's going to depend on what the structure of gold says at that particular time. That's really what it comes down to. And I'm not going to know until we see that next bigger rally off the next lower low. And then that'll tell me what I think I need to know. And I'm going to mention something about your silver sale. I think junk silver is probably the most important silver to hold. That's my opinion.
You can say that as often as you want because we're going to offer some here tonight. So
I
tend to agree with you.
I'm telling you, I think junk silver is one of the best ways to hold silver.
All right, I got a couple quick ones, and then we're going to make kind of the round table to make sure everybody get their parting thoughts in. So an anonymous attendee came and said, any thoughts on PHYS given its Canadian location?
Again, take a look at the prospectus.
Yeah, good
You know,
point.
I'm an analyst. I'm not all knowing. I have not read every prospectus on every product out there. Please read your prospectus carefully.
Good point. Can't say it enough. David asks, when does the bond market go to 10% or greater, late 20s or late 30s?
This is where I have a meme with a guy with a turban with a crystal ball, and he's playing with the crystal ball. I don't have a crystal ball. I can't tell you specific timing. I can tell you that when we complete a corrective rally in TLT, you will then see it set up a bond market crash. And right now, my guesstimate is the end of this decade into early next.
Thank you. And there was a follow-up. Why? And I don't know if I missed it as I was reading other questions. Why do you think junk silver is the best way to own silver?
Well, why do people own silver? Because they view it as a medium of exchange in case everything goes to crap. Now, if you have really nice pieces of silver, do you really want to exchange really nice pieces of silver, you know, for bartering and so on and so forth? No, that's why junk silver is there. Junk silver holds value as silver and can be used in the event everything goes to crap. That's why I view junk silver as probably the most important silver to hold, because it actually satisfies two purposes for holding silver.
Yeah, even right now, given the crisis in Iran, you can still buy a gallon of gas for 2 quarters, 50
There you
cents.
go.
So, all right. And the last question I'll take before we do the round robin, Jama asked, what's your view on Bitcoin? Do we have time to get into that?
I am not our Bitcoin expert. Our Bitcoin expert is named Ryan Wildday. You can look him up. He is probably, my opinion, and the reason he is with me is because I saw him as truly the best Bitcoin analyst that I've ever come across. Not only does he understand the fundamentals of crypto just as well as anybody else in the world, he has applied Elliott wave analysis to stunningly accurate targeting for Bitcoin. Ryan got us all out of Bitcoin as we were approaching his 125 target. And right now he views it as having begun a major bear market, where ultimately we're going to be going down from what I remember to 40,000 or lower. So our expectation is that Bitcoin is in a bear market. And when you get down to those levels, I will start focusing on it a little more, because I know he got me into Bitcoin and Ethereum at, I mean, pennies as to what it is now.
Fantastic. All right, Avi, we'll start with you because you're the most important. You're our guest. One more time, I'd like you to make sure people know how they can reach you. Now, for anybody who's not been to our webinars before, we're going to come out with a replay tomorrow. So there'll be an email to everyone that registered, whether you attended or not. You'll get the link to the full live replay of the webinar. So you'll have that for your records. And we'll have contact information for everybody. But for those listening tonight, Avi, how can people get a hold of you? And if you had to leave them with one point tonight, what is it?
Okay. Well, first, I'd like to take a moment and thank everybody for their patience about me not showing my face on here. It is a promise I made to my late wife, and I have to keep that promise, which was made up until my youngest child is turning 18, and I have another year for that. So I thank you all for your indulgence on that matter. You guys can find me if you want to come into Elliott Wave Trader. We have a 2-week free trial, and you could actually chat with me in the chat room. I am there all the time. You could post something to me, and if I'm not there, I'll answer it when I get there. But I am there quite often, and I have discussions like this. We talk about stuff like this via our chat room all the time. So feel free to come join us. The one main point that I probably want to make is that please do not buy into most of the fallacies you see in the markets today. Most of what you hear in the media, most of what you read in the media, based upon fallacies that believe market paradigms are mechanical. Market paradigms are not mechanical. You don't pull one arm and the other arm goes this way. How often do we see markets move in directions that are completely opposite of our initial expectations based upon these mechanical paradigms? Do not buy into mechanical paradigms. Markets are non-linear. Therefore, please recognize that in the long term, there is probably a lot more risk in our equity markets than most believe. And at least know how and when to protect yourself. That's probably the most important point I can make. I am a long-term investor. I am sometimes a trader, but my goal is to hold on to all the profits I have made, especially at my age. I'm turning 56, and I want to hold on to all the profits I've made. And you have to know when and where to take your chips off the table. And just if you learn when and where to reduce risk when risk is high, that's probably the most important thing you'll come out of with.
Fantastic. Adrian?
Yeah, well, people can reach me at the website, adrianday.com. Obviously, since I say obviously, but it's obvious to me, since we're a money manager, we can't offer special deals to anybody. I mean, I could say if you sign up tonight, I'll make sure you buy the stock that's going to go up 100%. That's a joke in case anybody doesn't get it. So, with regard to final words, well, first of all, thank you, Avi, for coming on. I found it really interesting. As someone who's really on the periphery of Elliott, as I say, I always enjoy listening to Bob Proctor when I hear him speak and so on and so forth, but I'm not what would be called a practitioner. I thought your closing words were just excellent advice to any investor of any age, of any risk tolerance. I guess two things would occur to me. One is, there are many paths up the mount to the top of the mountain. And I think it's a matter of really understanding what it is you're doing and whether or not it makes sense. Because as you say, a lot of things, a lot of schemes or methodologies that people use simply have no foundation. The other thing I would say that was really interesting, you talk about being a long-term investor, but when you talk about the potential risk in the market, I would warrant that today, most people in the market, certainly most people under 50, just think the idea of an 11-year bear market, let alone a 21-year bear market, is just fantasy land. Just unrealistic, but we know that it can happen. We know that it's happened before, and you've shown us that. And I think people just have to be prepared for those kind of very, very long and very, very deep declines.
Fantastic. How can people reach you?
Well, I said it before, but I'll say it again.
Yeah.
It's www.adrianday.com.
All right. And before I let you go, I'm going to ask you one more thing. We've identified our next on the move guest. Can you want to share that with everybody tonight?
Yeah. So our next guest, we don't have a date locked down yet. It'll be in June. It'll be in June. We don't have the exact Wednesday tied down yet, but it'll be Dr. Mark Thornton, who's adjunct professor at the Von Mises Institute. I'm sure many of you have heard his videos, heard his talks before. He's an economist, but he's also an economist who has an awful lot to say about the markets. It'll be a different sort of conversation than the one we've just had, but I think it'll be an equally interesting one.
100%. Yeah. And thank you, Adrian, for securing him for us. Looking forward to that conversation. My parting thought is, very simple. Know why you're owning whatever you own. I think is a big part of, the analysis you have to do when you look at your portfolio. I mean, I've talked about it before. I know why I buy gold. I know why I buy silver. And as a result, I have certain allocations and I handle them a certain way. And I think whether it be stocks, bonds, cash positions, whatever, as long as you know why you're buying it, it makes it a little bit easier to make those decisions along the way as to how to hold it, how long to hold it, when to get in it, when to get out of it, if at all, ever. So keep that in mind. Don't let emotions dictate your moves. Do it with a rational mind. I think there's a lot of better decisions done rationally than emotionally. How to reach us, www.assetstrategies.com. You can call us toll free, 800-831-0007. That is 10 better than James Bond for all those keeping track at home. And I said there's a deal. We're going to offer junk silver. I think it's the best way to own silver right now, to be honest with you. We can offer that junk silver, Avi's favorite method of owning silver, at $3.49 below spot silver. You can buy silver below silver. Okay. And that's just simply because in the secondary market, when we hit the peaks, a lot of people divested. They took the opportunity to take profits or what have you, and they sold that back. And our wholesalers are buried. You have to, look for the hand sticking out of the pile of coins right now. And as a result, they need to move it. And we can offer it lower than silver. So give us a call tomorrow. Reach out to us via the website, what have you. But that's on sale for those that attended this webinar, and that'll be in the recap as well. Adrian, as always, thank you so much. You're amazing. I love spending time with you. Avi, what can I say? You dominated a show with just incredible information. I think all of the comments I saw were that everybody was appreciative of what you shared with them. I could tell you I have been in Avi's chat rooms and I am lost most of the time. But they're not, and that's the important thing. So by all means, take a look and spend some time with Avi. Take that free look to see if it's okay. And by all means, take advantage of Adrian's services. I've said that before. We love him to death. So, and thank you all for coming tonight. With that, we'll part ways. Have a great evening.
Thank you both.
Thank you. Oh, someone just said